Hey guys, welcome back to another video by Fully Informed Trade, or FiTrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just here to go ahead and review the markets, talk about the basic markets and what's going on these days, and just go ahead and review what I talked about before, talk about what's happening right now, and just try to get some stuff off our chest, because today has just been a wild day. Dow Jones has been down by 348 points. Silver has dropped by 7%. Today is a very, very volatile day, so let's get into the market side action and just get into the details, because, again, there's a lot of stuff to go over, so I will be talking relatively fast. Alright guys, first of all, dollar index has had a substantial rally throughout the day session. You can see this really strong reversal just midday, just ripped the dollar higher. And basically what's causing this flee to the dollar is uncertainty behind stocks, uncertainty behind commodities, and obviously, people just don't know what the heck to expect out of these markets. So again, the dollar is always the refuge of safety. Whenever things do go a little haywire, whenever that happens, you will always see a substantial rally in the US dollar index. Moving on, the Euro-US dollar has continued its downward trend. I did point out that I didn't really like this double topping pattern on my Facebook wall earlier. Another thing that I really did not like was the fact that we were still in a downward trend. It did manage to break above this upper channel though, but it has not been able to break above this double topping pattern before going lower. Again, I wasn't too convinced about the Euro-US dollar trade. I was convincing people to get out of the trade at 1.44. Subsequently, it did start pulling back at 1.45. Basically, you would have missed out on 100 pips of profit, but that's if you were able to even even if you were able to time the top properly, which again, most investors rarely ever do. Just try to make as much profit as you can, but don't take on too much risk. Again, in this market, it really is not worth it. Moving on, I want to go ahead and talk about the Dow Jones Industrial Average. I honestly thought that the Dow Jones Industrial Average was going to be able to find some support on that 200-day moving average. It hasn't really been able to. And because of that, we basically broke through this area, and a lot of people are pointing out this infamous head and shoulder pattern. The only problem with this head and shoulder pattern, though, is that it is not symmetrical. Like, for example, you need this, if this shoulder was working a little lower like this, that would be okay. Alright? Because then it slants lower, and later on you could, figure something out. The only problem with this head and shoulder pattern, at least, is that right now this head and shoulder pattern is not, this shoulder is taller than this shoulder. And that usually doesn't work out too well. And usually it's not a real head and shoulder pattern. But again, most technical strategists will interpret it as a head and shoulder pattern just because everyone else is. So again, I'm not really sure how long this pullback will last, but let's go into the economics behind why this pullback is happening. The cuts that have happened seem to be a little strong. And the effects on the economy from spending cuts seem to be much more severe, and how people are interpreting it, it's supposed to be much more severe, and that's why the markets are pulling back, because people honestly think that the U.S. economy can't sustain its current growth without excessive government spending, and to a degree that may be true, and that's why markets are reacting negatively. And without government spending as much as they used to, you're not having people get as many work contracts, people aren't getting as many contracts, people aren't getting paid as much, people aren't being given as much work. And up until this point, people have been relying upon our government to subsidize, not only just subsidize a lot of our growth, but to also, inflate the economy through the Federal Reserve, which, again, the Federal Reserve has already ended its quantitative easing 2 program. Now you're seeing government spending being cut back, and with government spending being cut back, it also implies that we're not going to get as much money into the economy. And remember, the government has to borrow an excessive amount of bonds, spend it excessively on programs, and with that money being spent on programs, people get paid, people get work, and etc., etc., etc. Right now, because the spending is being reduced by the government, we are expecting a certain amount of contraction in the economy. Now, if you have a $2.8 trillion cut over the course of 5 years, perhaps, if that's $2.8 trillion not being spent over the course of 5 years, Now, if you imagine that for a second, that means that approximately $480 billion per year is not going to be used to inflate our economy, basically. And that also leads to a money multiplier, but not really a money multiplier, but the money multiplier effect works against itself in that case, and again, credit contracts. The economy doesn't grow, so it contracts, and therefore, in an environment where the government isn't spending as much money, it's starting to cut back, it's regressing. Economists are agreeing on this consensus, and the fact is that we are agreeing on the fact that this economy can't grow with as much government spending. And with as feeble as our economy has been growing, and as weak as our recovery has been, this is going to be the biggest has-been in history. The U.S. was supposedly the greatest superpower in the world. It probably will be for maybe the next couple decades. But the point I'm trying to bring out now is that the government has finally cut back on its spending. Therefore, the economy has to contract because the government isn't spending as much money. It's like one of the biggest world's consumers reducing their spending, and therefore the end of spending results in a reduction in gross domestic product. That's just the way it works. Now, let's look at the gold chart. Gold chart has had a pretty severe pullback. Now, you know, this kind of looks like a topping pattern, a topping tail, and the main reason why I want to point that out is because it's a rising star pattern. And a rising star pattern is pretty bad, and in that if you see a rising star pattern, it means that markets can't determine where it wants to go, and it either consolidates for the next couple days before going lower, or it has a huge bullish, a huge bullish engulfing pattern, and bearish bullish engulfing pattern the next following day. And what I mean by a bearish engulfing pattern is where a whole candlestick engulfs the previous candle and it continues to go lower. And we see gold have severe pullbacks in the past, but this could be one of the biggest pullbacks for gold if in the case the dollar continues to appreciate in value at the rate it has. And I also want to go back to the Dow Jones Industrial Average, and that it has been a very long time since the Dow Jones has pulled back by around 300 points or more. Whenever you see something like that, you can interpret it as being relatively negative. This could be more severe than your typical correction. In that, the previous correction we had, it was just a flash crash. And what I mean by a flash crash was that, somebody hit a big finger, they sell 7 million, S&P 500 lots on the futures market. Therefore, computer algorithms sort of worked their way and started selling off their stock positions in response to the futures market. However, in this case, we have fundamental reasons for not wanting to buy into this market. And, again, I thought the 200-day moving average was going to be decent support. It never worked out. Markets weren't able to find much support. I figured that the head and shoulder pattern wasn't really going to be that real. Again, market participants just want to get out of their positions. And they want to get into the bond market, because that's where they feel the refuge of safety is. Therefore, the interest rates are continuing to go lower, which is a total paradox. Interest rates going lower, stocks are going higher, commodities are pulling back, and the dollar index is going higher. That's the way the markets usually roll. The bond and the dollar index, the bond market and the dollar index usually work together. They always go in the same direction, most of the time. Stock market usually reacts oppositely to the dollar index and the bond market. Commodities will react based on supply-demand characteristics, but in certain instances where the dollar is suddenly being hoarded and people are just jumping into the bond trade, silver and gold can sell off. And that's kind of what I was mentioning yesterday, or the day before yesterday, is that the gold and silver trade can work against you in an environment of rapid contraction of credit. If credit contracts, the money multiplier effect works against itself. Money is no longer being lended, economic growth slows down, and therefore the value or the amount of money people are willing to spend on gold and silver does reduce. And that's the whole entire issue I've had with commodity trade for quite a while. Okay, so again, this is what I want to say about the silver market. Silver market has been hit hard. Okay, this is probably one of the biggest sellouts I've seen in silver in quite a long time, except for the one that I saw a couple months ago. And again, this could be the second leg down for silver. And don't be panicking. If you're part of the silver trade for the longer term, this really shouldn't be an issue. But over the short term, I do see silver pulling back and continuing its downwards momentum. Now, could it reach the 200-day moving average? I think it could. I think it's most likely that it will go back to the 200-day moving average. Could it go below that? Yes, there's a possibility of it, and that all depends on the economic data we get coming out of coming out in the next couple months. So again, silver I've mentioned a lot of negative things about it before. And again, you know, silver has had an 8% pullback. This is a humongous bearish engulfing pattern. And it's just engulfed around 2 days of positive gains. It has engulfed 2 previous bullish engulfing patterns, and it has just dwarfed it. So again, this is a dwarfing pattern, and this is just very negative for the silver market. Again, I just wouldn't trade it right now. But I do want to go back to the Dow Jones Industrial Average. This is also bad as well, because remember, we've had support at this level before. And this is what happened throughout the Japanese earthquake and the tsunami phenomenon. Remember, guys, the tsunami, earthquake, Nikkei fell by 10% in a single session, Nikkei 225. And again, global markets reacted very negatively to that. Remember, Japan is the second, or currently the 3rd largest economy in the world. But at the time, it was the 2nd largest economy in the world until it got surpassed by China. But Japan's economy just got hammered, and the stock market fell in the Nikkei 225 by a bunch. Global markets reacted very negatively to that, including the Dow Jones Industrial Average. U.S. investors panicked. They sold their stock positions, and again, we're back down to that level, and we've already pierced it. So, again, you can interpret this relatively negatively, and I wouldn't blame you. If this level is broken, you could anticipate this market to continue going lower. And I want to go ahead and show you guys a monthly chart. And this monthly chart looks ugly, okay? So this kind of looks like a head and shoulder pattern. But what I want to really show you guys right now is something different. This is the monthly chart, and you know, the thing about this chart is that, you know, this is kind of points that I mentioned in the past. Well, not necessarily points I mentioned in the past, but this is something some market strategists have kind of pointed out. Right here, you know, this movement upwards, alright? And just imagine, if we break below this level, this market is going to come crashing down. There's no doubt about it. One second. Yeah. So, again, where's the level that you guys got to really watch? Okay. It has to be. It has to be this one right here. And unfortunately for you guys, it's already broken. So again, this could be a multi-month downward trend. And this is kind of what I was pointing out towards the beginning of the year, that the second half of 2011 will be the bearish half. So again, that being concluded, this is what I see about markets, at least in the short time I've had. This is my review on markets, my brief review. And I guess I'm going to have another video for the stock portion and a couple commodities as well. So again, take care, guys, and I'll hope I see you guys next time. If you want charting software, there's a link right below the video, and you guys could, I guess, use the one I'm using. And if you want, subscribe to my YouTube channel if you want more content like this in the weeks and months ahead.